Have you ever wondered why mutual fund investors give up so early? It's a question that puzzles many, particularly when you consider the wisdom shared by the world's richest investor, Warren Buffett. His favorite holding period? Forever. But it seems that philosophy doesn't echo with India's mutual fund investors. A startling trend is emerging, one that sees the majority of these investors redeeming their mutual fund units within a year or two of investment. It's a far cry from the long-term investment strategies often extolled by financial experts. This trend, in fact, points towards a dilemma, a conflict of interest between the notions of quick money and enduring investments. And the numbers? They paint a clear picture. Over half of the mutual fund units of regular plans were sold or redeemed in just a single year. So what gives? Why the rush to redeem? It seems that the world's richest investor, Warren Buffett's favorite holding period of forever, doesn't quite resonate with India's mutual fund investors. A recent report by the Securities and Exchange Board of India, or SEBI, throws some light on this perplexing phenomenon. This detailed report, a treasure trove of data, has revealed some facts that are nothing short of startling. In the last financial year alone, more than half of the mutual fund units of regular plans were sold or redeemed within just a single year. That's right, within 12 months, over 50% of investments were cashed out. But that's not all. The report goes on to paint an even grimmer picture of the situation. During the financial year of 2022 to 2023, a staggering 73% of mutual fund units were redeemed within just 2 years of investment. This essentially means that nearly 3/4 of the total investments didn't even make it past the 2-year mark. As if these figures weren't concerning enough, the report throws in another shocker. Only a minuscule 3% of the units saw an investment period of more than 5 years. In the world of mutual funds, where long-term investments are the norm, this is a figure that is alarmingly low. Now, these facts raise several questions. Why are investors, especially those in mutual funds, giving up so early? What's driving this trend of premature redemption? Is it the lure of quick money that's leading investors astray? Or is it the fear of losing their hard-earned money in the short term? These are questions that the industry needs to ponder upon. In a financial landscape where the mantra is to hold on to your investments for the long haul, these figures are indeed a wake-up call. They underline the need for financial literacy and awareness among investors, and perhaps a rethinking of the strategies employed by mutual fund companies. This high rate of early redemption is indeed an alarming trend in the mutual fund industry. It's a trend that needs to be thoroughly examined and addressed for the benefit of both the investors and the industry as a whole. But what's causing these investors to jump ship so early? Well, it seems that the allure of fast cash is a significant factor. With markets now literally at the fingertips of investors, it's easier than ever to compare returns between different mutual funds minute by minute. This constant barrage of short-term news and information can play tricks on the mind, leading to biases and a heightened fear of potential losses. In addition, the ease of access to these comparisons can create a sense of urgency and pressure to make quick decisions. This, combined with the natural human instinct to avoid loss, can result in investors pulling out their funds prematurely. The result? A cycle of early redemptions that could potentially rob these investors of the benefits of long-term investment. It appears that the fear of losing money in the short term is overriding the potential benefits of long-term investment, a trend that is worth further exploration and understanding. So, how long should one ideally hold on to their mutual fund investments? Now, there's a question that's been keeping investors up at night. Well, here's the answer, straight and simple. The ideal holding period for an equity mutual fund is generally considered to be a minimum of 3 to 5 years. Yes, you heard that right. Not a few weeks or months, but years. But here's an even better approach. Try linking your equity fund to a long-term goal. Maybe it's your retirement or your children's higher education. By doing this, you're naturally motivated to invest for the long term without constantly worrying about how many years you should stay invested for. Remember, the greatest investors in the world are not those who made quick bucks, but those who stayed patient and reaped the rewards in the long run. As the saying goes, investing is a marathon, not a sprint. Patience is indeed a virtue in the world of mutual funds.